Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 178. Now, today, what I'd like to do is discuss a couple of news tidbits that are going on in the marketplace. We'll talk about the Amazon news and the tweets that are going on here. We'll also look at just US-China trade war talks and talk about some IPOs like the Spotify IPO that's recently been announced and released, and my thoughts about trading IPOs. I've talked about this in the past, so if you've watched some of the other videos about IPOs, you probably already know what I'm going to say. But we'll also cover some stock charts, at least the popular ones there towards the end of the video. If you want to see more of the stock charts that I watch along with some insights, then you may want to take a look at our critical chart service that I offer. And you can take a look at that at tradersfly.com. So when you go here, you can see all the recent charts here that I've posted along with the video recaps. So anyways, with that being said, let's take a look here with what's going on in the marketplace with some of these news events and catalysts. So first things first, we have Trump that constantly talks about Amazon here, and it did hurt the stock a little bit, but that's not to be unexpected from all the volatility that we've had, along with Amazon's price being a little bit up there. So as you look at Amazon overall and you take a look at the weekly chart, you can see we've already had a fairly accelerated move, right? And then when that broke down, that's kind of a lot of the times or opportunities where the tweets were taking place. So if you want to look at the acceleration of the move right here, you can see we broke this actually in a clean way a little bit earlier, but over here we broke it, and now we're trying to hold up right there at this price point, which is right around, let's see here, if we look at it, about 1350, 1355. So we might be getting a couple of days of bounce here, but then we'll see if we'll roll over or can hold and stabilize here. Remember, earnings are coming up right around the corner within about a week to 2 weeks. So we should see some fuel or a little bit bad selling in the marketplace, whether that happens to be Amazon or many other stocks. So you're going to get some fuel one way or the other, whether that's to the upside or fuel to push stocks lower. So, as far as looking at Amazon and imposing specific rules and threats on Amazon, I think the company is quite large and big overall. So I think it would be a little more difficult to do that, especially when, the party that you represent as far as in the White House is also pro-business. So, you are always for helping businesses out. But, with Amazon being so big, I'm not sure if you can single one company out to impose higher taxes or restrictions, because that would also mean, you'd have to impose that at certain limits as you go into tiers, right? Just like you would with, income taxes. So anyways, with that in mind, there's been a lot of movement and whipsaw action as well within just overall futures because of China talks and the China tariffs. And this, of course, started with the US. It started with us. We said, hey, we're going to impose steel and aluminum tariffs. China retaliated just slightly, just to kind of compensate for it. Then the US said, hey, we're going to hit you with bigger tariffs, because of intellectual property, the pirating that goes on, just a lot of these kinds of things. And China said, well, hey, these are the ones we're going to hit you back with. So, hey, if you want to play that game, we'll play that game too. You can't stomp and, go head to head with other countries. When you're living in a connected society, in a connected world, as Stephen Covey said, you have to create win-win situations and win-win relationships. It makes things much more difficult when you're trying to actually fight and win things rather than create synergy together. And, as you probably know, the administration that we have now is looking to kind of strong arm things rather than create a win-win solution for everybody. So with that in mind, it creates a lot of tension, especially in the marketplace. And that's one of the reasons why we're getting a lot of the whipsaw action, especially over here as you take a look at it with futures that were down pretty big, and then we got snapbacks. So yes, you could say we're getting some snapbacks right now. And if you look at it on a day-to-day basis, that's fine. And you might say, hey, over the last couple of days, the S&P has risen maybe, between the opening or between the futures, it could almost be 100 points. or the Dow almost 1,000 points. But remember, tomorrow it could be down 500 points on the Dow, or it could be down 50 points, 60 points on the S&P, because these are the times we're in. Now, I think we're kind of starting to base a little bit here at the 2,600 level because we've hit it twice. But just understand that, you know, 1 or 2 days doesn't make a trend. 1 or 2 days is just 1 or 2 days. When you're looking at the bigger picture, you need to look things out further. What do a couple weeks tell you? What does a couple months tell you? And right now, if I look at it month to month, we've really had 2 very solid down months and almost a third already. And we're not even done with this 3rd month yet, of course. So this could actually turn into a negative month as well. And that could really start to play and hamper throughout the rest of the year, that maybe we don't get a 20% correction, you know, or a 50% correction in the marketplace down to, let's say, 1,700. But what you could do is have kind of a trickle effect to where you're not really growing in the marketplace, but you're stagnant and you're kind of isolating in this way on a slight pullback. Now, I think that's also healthy, but just understand that, hey, that could happen as well. So overall, when you look at the days that are red, there's quite a lot more here than when you compare it, let's say, over here or over here. Now you have many more red days there that are coming into play recently. Now, we do have some positive news, at least for new investors. If you're looking for, you know, investing in like a new IPO like Spotify, if you like investing in new companies, that's fine. Spotify did get released. And it's called SPOT. I believe this is the ticker symbol, so here it is. This is a 10-minute chart, so you could see we opened up about 165. And for me personally, when I look at IPOs, I don't really care to invest in IPOs, at least not the first month or two. Usually I like to give them a couple of months of digestion. Doesn't matter what the company is, because a lot of them do fail. But some do work out, and they may have some good movements in the first few months, and then maybe that's it and they're done. And if you look at this, yeah, if you were kind of the first one here to get in, and you can see there was a lot of people dumping shares because the early investors that got in it 10 years ago, 5 years ago, many years ago, are trying to dump and maybe get rid of shares. Now, some of them are locked in play and they can't get out of those shares, but they will eventually. It could be 3 months, 6 months that they have to hold in the open marketplace. That way they all don't sell at once. So you could see here we did have kind of a descending trend line. We had a bounce right there, and now again descending trend line, but this is just a 10-minute. If you look kind of on the daily, we're still kind of just whipsawing around trying to find a price level. If you compare this to kind of GoPro here and you take a look back at the weekly, you can see what happened when we went here sideways for about a month or two. And then finally we had a breakout. And this is what I'd rather see, is a nice little consolidation pattern. And then either a breakout or actually a breakdown is fine too, because eventually that'll set things up. Now, if you have a strong breakout, this means you need to be a little more careful and take profits into strength, because you get too far too fast. And that's when you can get some serious pullbacks. And this is what happened with GoPro, as you can see. And that's where we also created an A to B, B to C, and C to D pattern. Okay, so that's our pattern right there. Looking at many other companies like a Facebook as well, you can see when we first opened up right here, that first month or two, it didn't do that well. So we had a couple of even months here that things were just going kind of sideways, and eventually it broke out after about 2 years, and that's when the stock actually continued to move higher. So this actually, is what you're looking for, is a little digestion and then a move to the upside for the longer term investments. Take a look at Alibaba, the same thing. As it opened up, right here, you had a pullback for quite a while, and really you could say digestion for about 2 to 3 years. And then finally that breakout move and moving higher. So it does take time. And you could look at Twitter here. We've had our little open, a little nice gap up or pop for a little while, a month or two, and then we had trouble after that. So there was that initial euphoria, initial hype, and then problems, and now we've had problems for 2-3 years. So this is why I don't really like getting into them too early, because many of them can turn out to be like this. Look at let's see, it's Groupon. Groupon. Right here also, the same thing. You can see opened up around 25, but then had pressure moving sideways. Couldn't break out of this here. So what do? Continue, move lower, and now just really sideways. So you can see a lot of companies can do this, and just because it's an IPO doesn't mean it's a good investment. With a lot of other music services, if I was to compare Spotify, so when we look at Spotify right here, and you start taking a look at this, really what I could say is, even though every company, of course, is different. So yes, absolutely, it depends on your profits, your growth, what you're looking to do and expand in the future. But if you were to compare it kind of to other services, like take a look at Pandora, they charge as well, similar prices, and this is kind of what the stock did. So not saying Spotify is going to be identical to this, but I'm just saying this gives you an indication of a music service around the same price bracket, and you might have a breakout here, and it might be good for 1 year, 2 years, 3 years, and then after a while things just kind of declined, unless, of course, if you think with Spotify, they have some other potential growth behind other products, other services that they will develop. Other than that, I think the growth is a little more limited. So it doesn't mean it can't be profitable. That doesn't mean it can't make money. It doesn't mean, the company or the tool is not a great tool to listen to the music. It just means as far as an investment goes, there's not going to be maybe as many people piling into it right away at the beginning, or, let's say for 2 to 3 years. Now that could change if they start, acquiring things like Facebook acquired Instagram, those kinds of things. If they start acquiring companies and building that infrastructure out, now as an investment, it may be much more attractive. But as far as just a single music service, it's a lot more limited, I think, for now. Of course, that could change. So anyways, with that in mind, let's take a look at some other charts. So we've already briefly talked about Amazon, so we're kind of basing here at the 1355. If we take a look at CMG, this one's been moving sideways for quite a while, and I wonder if it's kind of ready to break out one way or the other, whether that's up or even down. So if we take a look at this one, it's kind of been basing here for quite some time now. So I wonder here what's going to happen, because the moving average is starting to get closer, and if we break out here, you might get a move slightly to the upside. I don't think it's going to be, a big long-term stock at the 700s again, but it could be, for a 1 to 2 month hold, it might be interesting. Tesla broke down below that 300 level, and now it's getting back above it. So we kind of went into the 250s, and now we're trying to hold that price level, and we got back above the 300. So we're back kind of in this descending triangle pattern. I think we'll have, again, a little more whipsaw action here if we don't get a rejection tomorrow, because remember, stocks are popping quite a bit today, or the last couple days. Netflix also holding this level here. This is our 275, 280 level. So again, also holding it, but again, it's still under that moving average, under the 300 level. So, the moving average is slightly rolling over. So we'll see if this is just a 2-3 day pop, and then we'll come back and maybe retest that price level again. If we take a look at Apple, also 165 seems to be the support level here. We have some action here that really took place around this price point, and the moving average is right there. So that could be a nice little area to build a position, but when you really look at it and you start looking at it on a weekly time frame, we've really just been moving sideways over the last 1 to 2 years. I don't know if this is more of a growth company anymore. It's more of a stable dividend play is maybe where it's going. So had some good consolidation sideways, and that could allow it to continue to run further to the upside with time, but they will need new products, because their product cycle is, the phones get old fairly quickly over time. If you look at Facebook also, the longer term upward trend line here is this angle, okay? Now, we did for a short period of time accelerate for about a year at that angle, but we got too far stretched, and that's why you get that pullback. So now we're coming back to more normal levels. If we break below this, that could create a little bit of trouble, and you could get into, you know, the 125s level there. But we'll see if that'll happen. I'm not really sure if this is just, you know, if we're going to get a shorter term bounce and then sell off, or you get a shorter term bounce and then you could continue moving higher. But ultimately, the line here is kind of the key, that upward line, and you can see that being drawn out for that extended period of time since about 2013, actually. Another one is here is Pepsico. I've been taking a look at this line and this angle for this stock. It did break below it. In fact, it broke below it a couple times and then it got saved. And now, again, it broke below it. The question is will it get saved again? Normally, these lines become resistance, so we'll see if it rejects it. But if it gets back in it, then again, you could continue following that trend forward. So that's another one I was taking a look at. I know P&G is also a popular one for many longer-term dividend investors that we have in our members area. And this one, you want to be careful here with the $80 level because it's struggling. It broke below this and it's rejecting a little bit at that price point. If we get above 80, that's a little bit more safe. But otherwise, the big trouble here is right around that 92, 93 level. And if you take that back into the quarterly, you can see that all the way in 2014, 2015, coming up right there. And the angle is kind of moving around that pace. So anyways, that's kind of a key level to watch. Shopify, also fairly big one. We came into this daily area of 110. We have some resistance over here that was now support, breakout, holding at those price points. And we broke below it, but we got a little bit above it now. And again, we're acting weak. So I would say when you look at the area of here, this recent price action, it's quite oversold. So I think we may get, again, a little bit of a bounce here if we can hold this 120 level with Shopify. But overall, price actions is acting weak. And if you get further panic in the markets, earnings are not the best, this could continue to accelerate lower. And if it gets below that 200-day moving average, that could become a problem. The angle that I'm watching, if you look at it, is we dropped from 2016 to about $80 level. And then if you draw an accelerated angle level, you could see it's more steep at about 45-degree angle from 2017 to about the 140s. You also have some resistance right there that are hitting a few points in 2017, 2018. So really, these are some of the angles and levels that you want to pay attention to. And the more recent ones right here would be just this angle where we were created in June, July, August, moving up to about 120. So that's why about that 110, 115 level, it should be support at most. And one of the reasons why we bounced here at those recent lows. So when you take a look at that angle, it seems to look okay. But if it breaks below there, we could have some trouble. So these are some of the main things I'm watching. Overall, the market, if you look at the S&P, I mean, the key takeaway here is the 2600 level is the key, but 1 to 2 days does not make a trend. So I want you to be a little more cautious. Don't buy into the hype that goes on that, you know, okay, markets are rebounding. It's amazing again, you need to buy things. Now, yes, sometimes you need to hedge or protect things. But overall, be careful and be a little more calm in these volatile moments. If you can't be a little more calm, I would say trade a little lighter, because I know sometimes it is a little more difficult to be more calm when things are whipsawing around. So trade lighter. Instead of, let's say, 1,000 shares, go to 500 or 300 shares. If you're trading 300 shares, go to maybe 100 or 50 shares instead. Lighten up your positions just because you want to see the trend or direction. And right now we haven't really seen a direction. It's more or less kind of a lot of whipsaw noise action. So you get a whip down, whip up, whip down, whip up. So it's a lot of noise, but there's no either trend, let's say, down or trend kind of up. It's really just this sideways distribution level. So if you're looking to invest in dividends on the long term, this is great when things are selling off and you can buy it at, you know, lower prices, and that way you can keep a rational mind. But You know, you don't want to be too crazy with your swing trading at this level, because it's just a lot of whipsaw action and a lot of volatility here with no exactly clear direction yet of what's going to take place. So be patient. Sometimes you can sit on the sidelines. There's nothing wrong with that. People that say, hey, well, why are you sitting in cash? You should be invested. You should be invested. Well, sometimes it's nice to have a peace of mind, get away from things. And when the market conditions are set up for you, then you get back in it. Just like, hey, you know, you may not enjoy running outside when it's raining. You might love running, but you just don't like it when it's raining. So the same thing here. If it's raining and it's not the right conditions, then it's okay to take a day off sometimes and, you know, sit back and, you know, read a book. So same thing here in the marketplace. Be patient, find your opportunities, and you can always get it back in later. Anyways, thank you so much for joining me today. Truly appreciate it. Don't forget to sign up to the newsletter by clicking the button right over here. That'll give you some more insights on when I'm releasing my new penny stock course, along with the option courses coming up for iron condors and calendars. And don't forget to subscribe to the YouTube channel. Thanks again. And in the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.